We want to talk about the impact on these markets, and we're going to do that with Rebecca Walser. We invite her into the stream right now. And she, as you should know, with Walser Wealth Management. She's the president. Good to have you here, Rebecca. I just lost all of my notes, but I want to ask you just very quickly. When we look at the dramatic drop we had on Thursday, and lots of people, it appeared, I'm not sure it was people, it might have been institutional investors, buying treasuries maybe to protect some money. Now everyone piling back into equities. What's the message to average folk like us?
Well, I mean, obviously it can go back and forth very quickly and people can get very confused. You know, we've had low interest rates, Adam, for really since 2009, the Great Recession and all of the TARP, buyouts that we did with the financial institutions. We've had interest rates very low for so long. And with all of the Federal Reserve stimulus that we are buying and that we did last year, 120 billion clip per month, so 1.3 trillion per year. And then you also add to that the 8 trillion approximately that was done through legislative practice regarding coronavirus. So I'm talking about the CARES Act, the ARP just last March, and then the additional act. We had 3 acts, about 8 trillion. So we put in a lot of money. Most of that money has made its way into equities, as we've seen. We rose over 2,000 points already since our low of March 23rd. So that is a very fast rise on a base of just 2,200. You can see intraday highs for the S&P today. So what's happening is people start to think, okay, we're going to have inflation, so then yields go up. And when people saw yields of 1.5 to 1.7 this year, they exit equities to some extent and buy some actual treasuries and some 10 years. But what we're seeing now is the Federal Reserve talking about their Jackson Hole meeting next month, talking about potentially tapering. And so people are saying maybe they won't be as accommodative as we thought. And then you get a shrink back to the other side. And that's when you see the yields drop, and that maybe that won't actually be as accommodative as expected. And so it's a really big seesaw, Adam. It goes back and forth and can be very confusing for the average investor. And that's why they really need to have a plan, whether it's buy low, sell high, stay for the long term, or if it's, looking at moving averages. But they just can't, constantly look at, because we're still in the middle of the recovery with the virus. These are unprecedented times.
I'm going to pick up on what you just said in a second, but the other headline today that potentially could impact how all of us invest, whether we are set it and forget it, passive investors, which is kind of what I do, or whether you're a retail aggressive trader. We have the president signing the executive order today regarding competition and alleged unfair practices by very large companies. Do you expect this EO to have a major impact on investing?
It's a really interesting one. It's like 72 different initiatives at my reading, and it looks like it's a lot of directives, Adam, telling the FTC that they would like, or he would like, his administration would like them to work towards this. A couple of really non-good things, I think, for the economy in this bill, or this directive, I should even call it. It's not an executive order with specific parameters. It's an executive order to mostly the FTC saying, I want you to look at these things. But I will just quickly touch on 2 points in the executive order that I think are worth mentioning regarding the market. The first is this really wanting to tackle non-competition agreements or non-compete agreements. They basically, and I'd like to see where they get this statistic because I think it's way too high. They're saying that about 30 million people a year are affected by non-competes, and that basically that's an entry to the job. But, I look at it from a business perspective, and I know that a lot of small to medium-sized businesses need these non-competes because they're hiring somebody who has a specific talent. They're investing a lot in these people. It's usually a 2-year limit. It's usually a very defined radius. And companies, small and medium-sized businesses, aren't going to take those risks on people without some kind of guarantee that they're going to get at least 2 years of loyalty from that person. And taking away that right, as an attorney, taking away that right from any individual to contract and make provisions of saying, okay, I'll give you 2 years in return for X, Y, and Z is a big problem. And it doesn't really make a lot of sense because unions do that at the collective level. So we cannot lose our ability to contract. And I think that this is going to be a question of constitutionality, of telling people they don't have a right to contract. So that's the first point I would say. The second point is you can see that as this executive order came out, all the FANG stocks really are performing better today. And I think that is because I think it's really a token anti-competitive situation here in this executive order. In other words, it's basically saying don't aggregate data, don't talk amongst yourself. All of that stuff is already done by third parties. And so I don't think it's helpful. Really, you've got 30 states plus doing Google. So yes, so I'll wrap it up. That's what I think. Yeah. Sorry.
And I should let everyone know we've got Ian Jeffries from the Association of American Railroads. He's the president and CEO. He's going to talk to us about some of the provisions in this CEO that could. I had to learn about what's called reciprocal switching, would become forced switching. We'll deal with that in about 45 minutes, but learn more about railroads than I ever thought I wanted to know. Getting back to equities, though. I'm going to target this question to people who are, say, between the ages of 40 and 60, looking at these markets. What should we be doing at this point? Is it a situation of set it and forget it, or are the good times really, they've got to come to an end at some point? We always get analysts tell us at least 10% pullback. We haven't had it yet this year. It's got to be coming this way, right?
Yes, Adam, always so. And honestly, like I said before, this is unprecedented times of so much massive stimulus. Obviously, we need the economy to keep going. I think it's going to be a big problem if we start to talk lockdowns again. I don't think the data supports that factually if you look at the closed states versus the non-closed states and the actual case counts and death rates. So I don't think that the data supports another lockdown, but we don't need to go back into a lockdown. If we do, or if we don't fully reopen, we're going to keep seeing volatility until the market really stabilizes as to what is post-corona look like. And I expect some volatility this year. I think everyone should be prepared. In the end, things will look to the positive, but I do expect it will be a bumpy ride because we're still dealing with the effects of going back to work and the virus.
What's the most common question you're getting from your clients and the people in your office? What are they being asked from people like us?
I mean, I think most people that are within 10 years of retirement want to know that there's not going to be a big crash that would really correction that would really jeopardize their ability to sustain that level of retirement wealth that they've built. And I think that, you can't give so many assurances right now because the data sets are just brand new. We've not seen this before. So I do think that people should be prepared for volatility. It's great that we're getting these highs, but we've had a very accommodative Fed and a very accommodative legislative session since last March. And, that is not going to continue indefinitely. So workers need to get back to work. We have a workers' stoppage almost, which I hope will end by September when the bump up stops at the federal level. But people should expect volatility. If you're a long-term investor, this should not be a concern for you. If you have a 10-year window for spending down funds, you need to be a little bit more cautious and protective.
We hear you loud and clear, those of us who are part of the 14-year club to retirement. It's good to see you. Thank you for joining us. Rebecca Walser, Walser Wealth Management's president.